Hello and welcome to The Exchange. We're live in Hollywood, Florida at Inside ETFs. As a reminder, today's interview is for informational purposes only. The NYC does not recommend investments or investment strategies. I'm joined by my friend Johan Grahn. He's the head ETF market strategist at Allianz. And I actually saw somewhere in the media you called the ETF boss. We'll get to that later.
I'll take it.
Look, Allianz and team, you guys are here. You're having a lot of conversations. What are you hearing from advisors right now?
Yeah, it's pretty cool actually. We have a very, very wide view from the advisors. I don't think I've ever seen this before. You have the best bull case and you have the worst bear case all at the same time. So in the short term, everybody's worrying about the same stuff. It's inflation, it is economic growth, it is a debt ceiling conversation. The list goes on and on and on. So in the near term, there's a lot of recession risk, a lot of conversation around that. Long term, advisors tend to be pretty optimistic.
So you've got a suite of ETFs that try and sort of fit into this balance. Tell us all about it.
Yeah, if you're worried about the systematic risk, I mean, it's really hard to be cute and manage specific risk in a portfolio, but if you worry about the big boulders, in our ETFs, you get exposure to the S&P 500. And with that, you get a buffer on the downside. It's either 10% or it's 20%. So if the market is down, you can buy it. If the market is down by 10% or less, you still get to keep the money that you invested.
Yeah. Look, we're ETF nerds. We kind of live and breathe this, but for investors and advisors that are listening, and explain what it means when we say there's a buffer.
Yeah, so basically it's absorbing risk from the market. So if you buy the S&P 500 in our buffer, you get exposure to the S&P 500. But if the market goes down over the next 12 months, we have a 20% buffer, for example. So if the market is down by 20% or less, you invested $1 million, you get to keep $1 million. But if the market goes up, you're capped in terms of how much you can make. So that's the catch, if you will. But you know what the cap is, and in this case, it tends to be around 15% if you have a 20% buffer. It's up towards close to 20% in a 10% buffer. So It's a pretty good trade-off.
So for an advisor, how do they actually start to build this into a portfolio? What do they do?
Yeah, a lot of times they look at their equity sleeve and they say, we may want to de-risk a little bit. You move money from equities into these ETFs. You can move it from lower yielding assets and bring it back into the buffer ETFs to get access to the equity risk premia. But the easiest way to get educated on this is frankly just to go to our website.
Okay.
So allianzim.com or bufferedetfs.com.
Okay.
One.
Easy to remember, bufferedetfs.com. Normally I'm talking about our website, but I'm going to stick to that, bufferedetfs.com. Great place to learn more about everything Johan and his team at Allianz are doing for the ETF marketplace. And again, Johan, thank you so much for the partnership. All your ETFs listed at none other than the New York Stock Exchange, the home of ETFs.